Hi, welcome back. If you have looked at silver prices this week, you have probably noticed something interesting happening. Silver has been trading up near $65 an ounce, and it is sitting more than 70% higher than it was just a year ago. Now, big moves like that always make people ask the same question. Why is this happening right now? And today, we are going to walk through the answer piece by piece, because what is driving silver at this exact moment is not one single thing. It is really a combination of two forces working together, the U.S. dollar weakening and the Federal Reserve choosing to pause on interest rates. Once you understand how these two pieces connect, the whole picture starts to make a lot more sense, and you will be able to follow precious metals news going forward without feeling lost. Let's break this down from the very beginning. The Federal Reserve controls something called the federal funds rate, which is basically the cost of borrowing money in the United States. When the Fed raises that rate, borrowing becomes more expensive, and money sitting in savings accounts or short-term bonds starts earning more interest. When the Fed lowers rates, or even just pauses instead of raising them further, the opposite pressure builds. And recently we have had a stretch of inflation reports, including the Consumer Price Index and the Producer Price Index, that came in cooler than many expected. That matters because the Fed's whole job revolves around keeping inflation under control while also supporting employment. When inflation numbers start cooling down 2 months in a row, it takes away a lot of the pressure that would normally push the central bank toward raising rates further. Now, this is important because markets do not wait for the Fed to actually announce anything. Traders and investors are constantly trying to guess what the Fed will do next, sometimes weeks or even months in advance. Right now, based on futures market pricing, the expectation for a rate hike at the next meeting has dropped significantly compared to just a month ago. A large majority of market participants are now leaning toward the Fed holding steady rather than raising rates again. And that shift in expectation alone is enough to move prices across the entire financial system, from stocks to bonds to currencies to precious metals. So how does a pause in interest rates connect to silver specifically? Think about it this way. Silver does not pay you any interest or dividend just for holding it. If you buy a government bond, you get a yield. If you put money in a high-interest savings account, you get a return. But if you hold physical silver or a silver-backed asset, your gain only comes from the price of silver itself moving up. That means silver is constantly competing with interest-bearing assets for investor attention. When interest rates are high or expected to keep climbing, holding silver becomes less attractive compared to something that pays you just for waiting. But when the Fed pauses, and especially when the market starts pricing in the idea that rates might eventually come down, that competition eases. Silver becomes relatively more appealing again, because the opportunity cost of holding it goes down. Now, let's bring the dollar into this picture, because this second piece is just as important as the first. Silver, like gold and oil, is priced in U.S. dollars around the world. That means when the dollar weakens against other major currencies, silver automatically becomes cheaper for buyers using euros, yen, rupees, or any other currency. And when something becomes cheaper for a huge portion of the global buying audience, demand tends to pick up. This is one of the most consistent relationships in commodity markets. A softer dollar tends to support higher prices for dollar-denominated commodities, and a stronger dollar tends to weigh them down. So when we see reports that the dollar has been sliding while silver climbs, this is not some coincidence. It is a fairly direct and well-understood mechanical relationship playing out in real time. Here's what this means when you put the two forces together. Cooling inflation data reduces the pressure on the Fed to raise rates. A Fed that is not raising rates and might eventually cut them tends to weaken the dollar over time, because lower rates make dollar-denominated assets less attractive to foreign capital. A weaker dollar makes silver cheaper for international buyers, which supports demand. And at the same time, a pause in rate hikes reduces the opportunity cost of holding a non-yielding asset like silver for domestic investors too. So you have two reinforcing pressures pushing them in the same direction, one coming from the currency side and one coming from the interest rate side. That is why this rally has looked less like a sudden spike and more like a sustained climb over recent weeks. It is worth pausing here and giving you some real numbers so this does not feel abstract. Silver spent much of the past year in a wide and sometimes wild range. It touched an extraordinary high earlier this year, then pulled back sharply during a corrective phase, dropping to the high $30 range at one point before working its way back up through the $50 zone and eventually reclaiming levels above $60. That kind of volatility is completely normal for silver, and it is actually one of the defining characteristics of this metal compared to gold. Silver's market is smaller and thinner than gold's, which means the same size of buying or selling can move the price by a larger percentage. If gold is like a large, steady river, silver behaves more like a smaller stream that reacts quickly to every rock thrown into it. That is not a bad thing, and it is not a good thing either. It is simply the nature of the asset. And understanding that helps you interpret the swings without overreacting to any single day's move. Now, let's talk about why this matters beyond just watching a number go up or down on a screen. For everyday households, currency and interest rate trends eventually show up in real life. A weaker dollar can make imported goods more expensive over time. Interest rate decisions affect mortgage rates, credit card rates, auto loan rates, and the returns on your savings account. So when you see headlines about the Fed pausing or the dollar falling, this is not just background noise for traders on Wall Street. These decisions ripple outward into the cost of living, the return on your savings, and the broader purchasing power of the money you already have. Silver's price move is really just one visible symptom of a much larger set of forces moving through the economy at the same time. Before we go further, if you are finding this breakdown useful, take a second to like the video and subscribe to the channel. It genuinely helps this kind of content reach more people who are trying to understand markets without getting overwhelmed by jargon or hype. And I put together new breakdowns like this on a regular basis. Let's also talk about the other side of this story, because it is important to look at this with balance rather than assuming the rally continues in a straight line forever. Markets rarely move in one direction without interruption, and there are real risks on the table right now. One is that inflation data can shift quickly. A single hot report, whether it comes from energy prices, housing costs, or wage growth, could change the Fed's calculus and revive expectations for another rate hike. If that happens, the dollar could regain strength, and that would remove one of the two supportive pillars we just talked about. Another factor to watch is geopolitical tension. Silver and gold both react to instability around the world, and any escalation in conflict zones, trade disputes, or supply chain disruptions can swing prices in either direction depending on how investors interpret the risk. There is also the simple reality that after a strong run higher, some investors choose to lock in gains, which can cause short-term pullbacks even when the underlying trend remains intact. Now here's a simple mental framework you can use to follow silver going forward, without needing to check the news every single hour. Watch three things. First, inflation data, specifically the Consumer Price Index and Producer Price Index reports that come out monthly, because these shape what the Fed is likely to do next. Second, watch the U.S. dollar index, which tracks the dollar's strength against a basket of major currencies, because that gives you a quick read on the currency side of the equation. Third, keep an eye on what the Fed actually says at its meetings and at major events like the Jackson Hole Symposium, because their language often signals shifts in policy before any actual rate change happens. If you see inflation cooling, the dollar softening, and Fed officials sounding less urgent about further hikes, that combination has historically been supportive for silver. If you see the opposite, hot inflation, a strengthening dollar, and hawkish Fed language, that combination tends to create headwinds. There is also a longer-term structural piece to this conversation that goes beyond just the current news cycle. Silver is not only a monetary metal that investors hold as a store of value, it is also an industrial metal used heavily in solar panel manufacturing, electric vehicle components, and electronics. This dual identity means silver demand comes from two very different sources at the same time: investors seeking a hedge against currency weakness, and manufacturers who need the physical metal for real-world production. Some analysts have pointed to a supply and demand imbalance, where mine production has struggled to keep pace with the growing industrial appetite for silver, particularly as solar installation continues expanding around the world. When investment demand rises at the same time that industrial demand is already tight, that combination can amplify price moves in either direction, which is part of why silver has been more volatile than usual over the past year. Thinking about possible outcomes from here, there are really a few broad paths worth considering, and it is worth holding all of them in mind rather than assuming just one. If inflation continues to cool and the Fed leans toward eventually cutting rates, that environment has historically been supportive for precious metals, since it tends to weaken the dollar and reduce the appeal of yield-bearing alternatives. On the other hand, if inflation proves stickier than expected, perhaps due to renewed energy price pressure or persistent wage growth, the Fed could hold a firmer stance for longer, which would likely support the dollar and create resistance for silver's climb. And there is a middle path too, where the Fed stays cautious and data-dependent, moving in small, careful steps rather than committing firmly to one direction, which would likely keep silver trading in a wide and choppy range rather than moving decisively either way. None of these outcomes are guaranteed, and anyone who tells you they know exactly what happens next is overstating their certainty. The honest answer is that markets are shaped by incoming data, and that data itself is not fully knowable in advance. What we can say with more confidence is how the mechanics work, even if we cannot predict the exact path. A weaker dollar tends to support silver. A Fed that pauses or eases tends to weaken the dollar over time. Cooling inflation tends to give the Fed more room to pause or ease. These relationships are well established, even though the timing and magnitude of any single move remains uncertain. Understanding the mechanism gives you a framework for interpreting new information as it arrives, rather than reacting emotionally to every headline. For everyday investors trying to make sense of all this, the real value in understanding this relationship is not about trying to perfectly time any single trade. It is about understanding why the metal moves the way it does, so that when you see a headline about the Fed, inflation data, or the dollar index, you already have context for what it might mean for silver and for the broader precious metals market. That kind of understanding also helps you stay calm during volatile stretches, because you can recognize whether a price swing is being driven by a fundamental shift in the macro picture or whether it is simply short-term noise within a larger trend. So, let's bring this all together. Silver's recent strength has been driven largely by two connected forces: a softening U.S. dollar and a Federal Reserve that has chosen to pause rather than continue raising interest rates, both of which have been supported by inflation data that has come in cooler than expected over recent months. These two forces reinforce each other, making non-yielding assets like silver relatively more attractive, while also making silver cheaper for buyers around the world using other currencies. At the same time, silver's industrial demand from solar and electronics adds another layer to the story that goes beyond just monetary policy. There are real risks to this trend continuing in a straight line, from potential inflation surprises to geopolitical developments to simple profit-taking after a strong run. But by watching inflation data, the dollar index, and the Fed's language at upcoming meetings, you now have a framework to follow this story yourself, rather than just reacting to headlines after the fact. That is the breakdown for today. If this helped you understand what is actually moving silver right now, consider sticking around because we cover these market shifts regularly and break them down in a way that is meant to build real understanding rather than just chase excitement. Thanks for watching, and I will see you in the next one.